Good morning, good afternoon, or good evening, wherever you happen to be in the world. I'm Doug Silliman, the president of the Arab Gulf States Institute in Washington, and I want to welcome you to a cold, rainy December morning in Washington, D.C., to the launch of the IMF policy paper, Economic Prospects and Policy Challenges in the GCC Countries. And our special guest today is Mr. Jerome Vacher, senior economist in the Gulf Cooperation Council Division of the Middle East and Central Asia Department of the International Monetary Fund. Specifically, he covers Saudi Arabia. He has also been an IMF resident representative in Tunisia and Ukraine, and a senior economist on Turkey and Spain at the IMF. Before joining the IMF, Jerome was a public finance economist in Paris and a financial attaché at the French embassy in Warsaw, Poland. So, Mr. Vacher, soyez le bienvenu. Happy to have you with us this morning. Thank you for being here. Our moderator for the discussion this morning is AGSIW Senior Resident Scholar, Dr. Robert Mogielnicki. Robert runs AGSIW's Looking East, the China Gulf Initiative. Last year, he published a book, A Political Economy of Free Zones in Gulf Arab States. And the Middle East Policy Council last year named Robert to their inaugural 40 under 40 list for influential Middle East policy experts. If you're interested in more information on either of our speakers, the two biographies can be found on the link to this program on our website, agsiw.org. So Robert, turn over the microphone to you to get started.
All right, thank you very much, Ambassador Silliman. The job of an economist has been described as studying the present in light of the past and for the purposes of the future. And I believe that that's a pretty apt description for our job today as we look at the GCC's economic outlook and policy issues. We know that the economic picture in the GCC is relatively rosy in our current moment. GCC economies are going to enjoy growth rates in the higher single digits during 2022. And some countries like Saudi Arabia and Kuwait are going to grow at a very substantial clip. You, of course, can't understand this growth picture, though, without looking to the past. Energy dynamics remain at the front and center of the GCC's landscape. And somewhat paradoxically, if we look back over the past couple of decades, the lack of substantial progress on economic diversification really is a major factor in the latest growth story, given the high, albeit volatile, energy prices. To put it a little bit more euphemistically, while the region's governments seek to diversify and continue diversifying public sector revenues beyond proceeds from the oil and gas sector, they stand to rake in substantial revenues and enjoy government surpluses as long as energy prices remain elevated. Energy dynamics, however, do not give us the full picture, and the IMF does praise the region's ongoing efforts in terms of economic reforms and fiscal consolidation efforts. And they also encourage regional governments to continue the reform momentum no matter what happens to energy prices over the coming months and years ahead. So where does that leave us as we look into the future to 2023 and beyond? Well, the IMF has given us a forecast for growth that is still pretty good, although not quite as high as 2022's figures. And we know that energy prices of late are not necessarily moving in a positive direction. On June 8th of this year, Brent crude was trading at about $123 per barrel, but it's fetching just about $76 per barrel as of December 8th. And those were just some figures I came across this morning before our talk today. So energy prices have been trending downward from highs earlier and in the middle of this year, and continued volatility is expected. And if it were only about energy, we have the war in Ukraine grinding on, recessions looming in the US and in particular in Europe, and there's tremendous degree of uncertainty about what will happen in China as the country's government starts to wind down and adjust its zero COVID policies. So how do we make sense of all of this as it relates to GCC economies? Well, thankfully, we have the good folks at the IMF to help us do that. And I'm going to turn it now over to Jerome to help us set the context for today's discussion. So over to you.
Good morning, and thank you very much, Ambassador Silliman and Robert, for this introduction. Let me thank you first let me thank the Arab Gulf State Institute for welcoming me today and give me the opportunity to discuss with you the economic outlook and the policies in the GCC countries. It's also a nice way to escape from the dreadful weather that we have in Washington today, at least for an hour. Let me maybe start with, so I will have a few slides for your consideration. And of course, as Robert said, I'm looking forward to a nice discussion. Let me start with maybe three remarks. First, this paper, which is now published, has been prepared for the GCC ministerial meeting that took place in Riyadh on October 3rd, which means that all the information in the paper, and in particular all the forecasts that we have, is based on the information that we had at the time. So that's important to underline, because of course, there are always new developments, and since the beginning of October, there were a number of developments on the economic front and fiscal front. But these, of course, do not change the main findings and the main conclusions that we have in our paper. The second remark is that this is an exercise that we do every year, and we are very thankful for the GCC and the GCC Secretariat in particular to give us this opportunity. And every year we look at the economic outlook, we look at the policies, and we also try to have more focus on some topical issues. So I just wanted to point out that in the report, we, for example, have 3 appendices which summarize some research we have done on very topical issues like the management of oil windfalls, the impact of monetary policy in the region, the inflation in the region. And we also have in the report a few focusing points, and again, I think quite topical. We have some analysis, for example, on the impact of the war in Ukraine. We have some analysis on food security issue, on corporate vulnerabilities, on digitalization, and so forth. The third remark I wanted to make before starting is that we also draw your attention to the fact that we have this report which covers the GCC, but we also have publications and reports which go more into detail in country-specific issues. And recently, in the past few months, we have published a report on the Saudi economy. We have published a report on Qatar and Oman. So I would also draw your attention to that, especially if you are looking for more specific country-specific information. Now, just to set the stage, and of course everybody is quite familiar with that, but it's important to remind ourselves of the context in which we are looking at the global economy, at the GCC economies. The global economy is under pressure with new shocks and growth stalling. The war in Ukraine has negatively shocked growth and contributed to higher inflation globally. Inflation has proven to be higher and more persistent than expected. Global financial conditions have tightened and continue to tighten. And the risks to the global outlook are firmly on the downside. It's also something that is reflected in our latest World Economic Outlook, which was published in October. Next. Very quickly, it's important to underline that the recovery that we have seen in 2021, in particular from the COVID crisis, has been broad-based, meaning that it's not only the oil economy, but also the non-oil economy. That's an important development. And that we also see this recovery continuing in 2022, of course, with variations across country, but with a strong cyclical momentum. Next slide. Thank you. At the same time, then we see this strong recovery. We also see developments on inflation, which tend to distinguish the GCC from the rest of the world. Even though we see an increase, we have seen an increase in inflation, it has remained broadly contained. And I can come back later to discuss more in detail what are the reasons for this. But we also expect inflation to moderate and go back to basically the levels that we have seen previously. Next slide. What we looked at in the report, and we have like a two-pager on our findings, is that the direct spillovers on the GCC economies from the war in Ukraine have been relatively small. The main impact, of course, for most of the GCC of the Russian invasion in Ukraine has been a spillover through higher hydrocarbon prices. But now when we look at the direct impact, in particular through trade, in particular looking at food imports and some of the other commodity trade, we see that the impact is relatively limited for a number of reasons. We also looked at the financial impact and the financial links. And overall, those are also relatively small. Of course, the impact of the war in Ukraine is still being felt. It's probably going to be felt for some time, and it's multidimensional. But at least on the direct impact, this is what we have found. Next, please. Of course, with the improvement of the situation, I'll come back to that, we have seen a very strong improvement in the fiscal situation. Whichever way you look at it, the fiscal situation has improved tremendously. And that means that some countries that, including where had deficits, are not going to have surpluses. And that's in line with higher oil prices and the receding effects of the pandemic, and also the dynamic non-oil growth that we have seen. What we found in the recent developments is that we see that the fiscal consolidation and fiscal consolidation tending to be relatively growth friendly has indeed been followed up, and with a strong commitment so far from what we have seen. And that means that, for example, compared to the previous forecast that we had, we see that the fiscal primary balance have sharply increased. And just for 2022, for example, we expect the fiscal surpluses to reach close to $100 billion for the GCC, which is a significant development. we also expect that most countries will strive to save the increase in oil revenues. We looked at past episodes, and there is one section in the report which looks in more detail at past episodes, and in past episodes of oil windfalls, and how countries have been managing compared to now, and we do see an improvement, even though that's still early in that cycle. Next slide. Obviously, we have not only an improvement in fiscal balances, but also a significant improvement on the external front. Then this is reflected in reserve accumulation, net foreign asset positions, which are significantly improving. And again, with most countries having surpluses in the region. Now, this is also in the back of a sound financial sector, even though we have to remain vigilant, and the authorities in the region have to monitor developments very closely. In particular, for example, something that we have a focus on is on the corporate sector. But what we also find, and we have done some research on that, is that the impact of tighter global monetary policy conditions, which is also directly reflected through an increase in interest rates by central banks in the region. What we find is that, with some caveats, of course, is that the tightening is likely to have a limited impact on our GDP growth, bank profitability, credit growth, and asset quality. So we looked at all these indicators. And that's because we are in a very specific situation of a high oil price environment, which also increases liquidity in the system. But there's obviously a lot of things going on at the same time. And as we mentioned further, the spillovers also to non-oil growths have been pretty strong as well. That being said, since the IMF, we also look at very closely at the risks to the outlook, and that's part of our remit to also look at this very closely. And these risks, and beyond calling them risks, but we can call it uncertainties around the outlook. And as we have seen globally, those uncertainties are pretty strong right now. There are positive risks to the outlook, including some oil price developments, some accelerated implementation of some structural reforms and investments with a positive impact of non-oil growth. On the downside risk, of course, there's always the risk of a resurgence in the pandemic. There's a risk that lower oil prices would be seen for some time and had lasting effects. We still have a number of things going on, and in particular, the tightening of global financial conditions, which is still going on. But also there are some domestic risks that we see, including some risk to macroeconomic policies domestically, and I will come back to that. And of course, in the background, we also have some more medium-term issues, even though we see that the needs and the risks are very pressing, but everything which is related to climate change and related mitigation policies are especially important for the region. Now, after this tour d'horizon on the economic outlook, let me now turn to what the policy priorities that we see for the GCC. First of all, we see that it's particularly important to secure fiscal sustainability and have a long-term perspective. And that in particular means thinking about the next generations, and also think about how to manage the hydrocarbon proceeds to avoid some of the mistakes of the past, but also to rebuild and stabilize fiscal buffers and reduce public debt. And there are a number of ways that can achieve that, including mobilizing non-oil revenue, and we have seen some efforts in the region in recent years, containing the wage bill, which is also something that we see in the region, and which is rather encouraging when we look at the past, the recent fiscal developments. Something that differs from previous situations of oil windfalls. There is also a need to gradually phase out some of the poorly targeted subsidies to gain some fiscal space. And here we think especially of energy subsidies. And finally, to also scale up some productive investments and investment in renewables. Importantly, what we see to ensure fiscal sustainability is a number of tracks that can be chosen, in particular to try to implement as much as possible credible medium-term fiscal frameworks, ideally with some fiscal anchor, looking forward and over the medium term and long term. Credible fiscal rules, sound debt management, and that basically includes that means also having a comprehensive view of potential liabilities, and making further progress in transparency. We have seen a lot of improvement on fiscal transparency in the region. There's a lot more discussion and disclosure on budgets, but there is also the need for constant improvement. That also includes, of course, anything that can be done to preserve the soundness that we have seen in the financial sector. And it's particularly important that at a time when financial sectors expand again in the context of high oil prices and liquidity, and there's always the need to monitor rapid developments. Anytime we see rapid lending in some sectors or in some segments, that calls for also close monitoring. That it's true in the GCC, but that is true everywhere. There are also things that can be done to improve the prospects for the financial sector, including continuing to work on insolvency and resolution frameworks, drawing on all the progress that has been made on fintech and digitalization, and again, we also have some focus on that in the paper, where we show the impressive progress that has been made and the leading role of the GCC in that, and continue, of course, to provide more financial inclusion. Now, an important discussion in the region, which is not new, is the issue of diversification and also the prospects for medium-term growth and competitiveness and how this can be achieved. We see that the pegged exchange rate regimes, which are an important consideration on competitiveness, remain appropriate for GCC economies, despite the global economic volatility and shock that we have seen. Now, preserving and continuously enhancing this competitiveness is an important consideration and is critical for promoting further diversification and investment. Now, it's always a very interesting discussion that we can have on economic diversification. We see that there are a number of ways to have higher potential growth in the region and also more inclusive. That means also focusing on issues like SME development, which a number of countries are doing, promoting digitalization, and so on. The agenda is quite rich on that. Now, this issue of economic diversification is critical for the region, as we know. It's not a new discussion, but it's a constant challenge. It's of course full with opportunities for the region. We see that, for instance, there has been a good progress which has been made on labor market reforms, and that will also allow higher productivity growth and diversification in the region. We have seen great progress being made, for example, in private sector labor force participation of nationals, in particular of women. And we have seen a lot of reforms in that area. We also think that continuing GCC integration and deepening GCC integration will be an important support for this diversification and lifting medium-term growth and competitiveness. And now, also an important consideration is the drive which is needed to achieve greener growth. And to a large extent, what we see is that diversification and a greener economy actually go very well together. So to conclude, just a few key messages for your consideration. With higher hydrocarbon prices, and we have seen the developments in the past few months, but also increased risk at the global level. And I would add to that what Robert has also mentioned, that is that there is a significant volatility in these hydrocarbon prices. The policy, in the short term, the policy priorities will depend a lot on the available policy space, and then to what extent, the authorities in the region also make room for that policy space, in particular on the fiscal side, and to what extent, some of the pitfalls of the past are avoided. Now, in terms of medium-term priorities for policies in the region, I think we find that GCC countries should focus first on securing sustainable fiscal positions, ensuring macro-financial stability, and that includes all the good policies that can be implemented at fiscal level, but importantly on the monetary side and on the financial sector, including ensuring the soundness of the financial sector. And finally, anything that can promote not only a strong but also inclusive, meaning that it would benefit all segments of society, and green growth will be important medium-term policy priorities to keep an eye on. So with that, I thank you very much for your attention. And if you need to know more, the report is online. We also had a blog piece on summarizing the key messages from the report, and we also have some publications in Arabic. So thank you very much for your attention, and Robert, back to you.
Thank you so much. That was wonderful and very good to help us set the context here. I'm going to pick up on a couple of points in terms of the economic outlook and also some of the policy issues and challenges, and then begin to weave in some questions from the audience. We already have a couple of questions. I would ask for any other audience members, now is a good time to start putting your questions in the Q&A box. There was one attendee who asked a specific question about the slide, I believe slide 8. If you could just go ahead and maybe clarify what particular figure you were looking to get a better sense of in terms of data, that would be helpful. And as Jerome mentioned, the full reports are online, so I do believe that any specific figures and statistics you're looking for, you will be able to find in the longer report. So with that, let me turn to the overall economic picture and the growth forecast. I believe the IMF put forth an average growth rate for the GCC of about 6.5% in 2022 and moving to about 5% next year. If I'm putting words in your mouth there, or I know a number of other banks at least put out those numbers, and there was a kind of broad, somewhat of a broad agreement there. Given what has happened over the past couple of months, do you still think those figures are accurate for, are accurate forecasts for regional growth?
Thank you, Robert. I mean, what we, as I mentioned earlier, is what we had in the report was basically based on, on the information that we had as October 3rd, which was the date of the GCC ministerial meeting, and was also consistent with the World Economic Outlook forecast that we published later in October. Now it's and what we had at the time was a real GDP growth of 6.5% for 2022, which is basically more than a doubling of growth compared to 2021, and GDP growth of 3.6% in 2023. And again, you can find all these numbers in our report, with relatively strong non-oil GDP growth, as I also mentioned, with basically something around 4% non-oil GDP growth in 2022, and about 3.7% for 2023. Now, of course, this is true for the GCC, but it's true for all the countries that we look at. Our forecasts constantly evolve with the global outlook and with the trends and the shock that we can see. I can only say that that there are important considerations for GCC countries, including the impact of oil production in 2023, some of the dynamic that we see and the numbers that we see on non-oil GDP growth, and we will have updated forecast for the World Economic Outlook update in January. So for a number of countries, and in particular for the most important countries in the world, including Saudi Arabia, which G20 member, will have updated forecasts and ahead of the spring meetings, and we also have some individual country consultations. Most recently we had one with the UAE, for example. So we do have opportunities also to present revised forecasts.
Thank you. Of course, the figures you gave us are averages. Can you give us an idea of what countries and what particular sectors are helping to drive this growth? Are you seeing a fair degree of variation between some of the strong, what we would think of as stronger sovereigns, larger economies, and some of the kind of fiscally weaker sovereigns? Is there a relative convergence in those growth rates? I mean, how is it racking up when you break them down on a country to country level?
Yes, as you correctly pointed out, this is of course an average for the region, and what we see interestingly is that at least in terms, and if we look at 2022, non-oil GDP growth is relatively similar across countries. With some minor differences, but mostly we are in the same range. The big difference is that, of course, the impact of higher oil prices and production are felt differently depending on the degree of diversification of some of the economies in the region. So clearly, in terms of the average real GDP growth, it hides some significant differences between countries. So of course we have different numbers from between Saudi Arabia, for instance, and Bahrain, just to cite a few, in terms of overall GDP growth, because the structure of the economy is also a bit different.
Okay, thank you. I'm going to move now to a couple of points that you mentioned in the presentation and that are spelled out in detail in the report. But the IMF believes that tighter global financial conditions and the Russian invasion of Ukraine are going to have a limited impact on GCC economies, or are likely to have a limited impact on GCC economies. I just want to ask, what other factors beyond those two factors then do you think could have a much bigger impact on GCC economies moving forward? And with that in mind, how are you viewing the developments unfolding within China, another large global economic player that certainly has some sway and some heft in the global economy? How are those developments likely to impact the economic outlook and the growth story in the GCC region?
Yes, I mean, Robert, that's indeed correct. That we looked at the impact of the direct and immediate impact of the Russian invasion of Ukraine, and we also looked at the direct impact that we could see of tighter global financial conditions, mostly in the US, emanating from the US. But also, of course, something that we see in other parts of the world. Now, what we have shown is that the direct impact of the war in Ukraine is relatively limited. Similarly, we have seen, because of the environment of high oil prices and relatively high liquidity, the impact of tighter global financial conditions is more muted. And here again, for example, we show that it depends a lot of the situation that we see. In situations where, for example, the oil price would be around $45, which is a relatively low oil price, the impact of 100 basis points increase in interest rates would be of around 0.3% of non-oil GDP. So there are some kind of threshold effects, and this depends very much again on the overall environment. Taking into account also that we have to be mindful of some potential corporate sector vulnerabilities, and this requires constant monitoring. Now, in terms of the other development that we see in the global economy, as you correctly pointed out, the GCC is very much integrated with the rest of the world. So developments, for instance, in China are important, and any developments in the global economy, for that matter, are very important for the region. Now, China is indeed the largest buyer of oil from GCC countries. It represents about a third of the purchases of oil from the region. And then, the other countries in Asia, like Japan, India, and South Korea, were also important purchasers. So that has offered some shield in the earlier developments in the global economy that we have seen, in particular in Europe. But of course, as some of the risk factors shift to countries like China with a slowing down of the economy, that will have also an impact on growth and foreign demand through foreign demand in the GCC as well. And it is indeed something that we expect to see to some extent in 2023.
Great. I'm going to ask one more question on the policy issue front before starting to integrate some of the questions from the audience. You mentioned non-oil revenue as an area where regional governments need to continue to make progress. Of course, new taxes and tax regimes immediately pop to mind when you're talking about non-oil revenue streams. And we know countries like the UAE are implementing, new corporate taxes this year, for example. So on the tax front, do you expect to see any substantial movements in either introducing new taxes or expanding existing tax regimes when you look across the region? And maybe a follow-on question to that, beyond taxes, are there any other significant non-oil revenue streams, other types of fees and other ways of generating revenue that you see as promising and potentially in the pipeline in the region?
Yes, thank you very much, Robert. It's a very good question. First of all, it's not necessarily up to us to preempt or to speculate on possible tax measures from the governments in the region or possible policy decisions. What I can say and what I can mention is first of all, what we see, which is indeed a development over the past few years of non-oil taxation, which is a positive development. And we certainly support non-oil revenue mobilization, as I mentioned before, including in a medium-term perspective. So we have seen that in the region, including through the development of VAT, for example, with now 4 countries having VAT implemented. So there have been significant developments in the region. If you mention the case of the UAE, we understand that the CIT tax will be phased in gradually, starting from the second half of 2023 and until 2025. And as such, the economic impact of the implementation of the CIT will be relatively gradual. Overall, the UAE authorities, but that's also valid for other countries in the region, should continue their efforts to broaden the tax base, improve the efficiency of tax collection and administration. And that is possible, also with the development that we have seen and the positive development that we have seen, including during the COVID period with the progress that we have seen in digitalization, which is a tremendous tool also to improve not only the delivery of government services, but also to improve tax administration. So there are a number of ways to develop non-oil and to mobilize non-oil revenue, including taxation, through different types of taxation. And there are many ways, including VAT, CIT, income tax, property tax, and so on. Now, there is also, if we talk about fiscal space, there are also different ways to make room for more fiscal space, and that includes continuing to rationalize some expenditures. I mentioned earlier subsidies and in particular energy subsidies. There is also room for that would allow also room to have fiscal space and to have a bit more targeted support to basically people who need it the most. So there are a number of ways, and not only on the revenue side to provide more fiscal space, but you mentioned non-oil revenue mobilization is an important component.
That's a good segue to one of the questions in the audience from Justin Alexander, who is asking about fiscal discipline, sends his thanks for an excellent report and presentation. And the question is, with the recent release of Q3 outturned data from Saudi Arabia, Oman, and Qatar, and also several budgets that have recently come out, is fiscal discipline still holding up broadly, and are there any areas of concern?
What we thank you for this very relevant question, and again the report that we have prepared was done as with information of beginning of October, which means that some of these later developments were not necessarily covered. That being said, the overall picture remains the same, and we do see a number of countries, and in particular Saudi Arabia, moving into fiscal surplus. Now, the fiscal surplus that is expected for 2022, and as reported by the authorities, is indeed lower than was initially expected, on the back of a number of developments that we have seen during the course of 2022. And as reported recently by the authorities, including an increase in expenditures on goods and services, an increase in capital expenditures, and an increase in military spending as well. So that means that the surpluses that we see for 2022 and also 2023, that the authorities see will be a bit narrower than initially expected. From our perspective, we also see that the wage bill continues to be contained, and that's a relatively positive development, and is in line with what I described earlier in terms of drawing on the progress that has been achieved in terms of fiscal reforms, and having a more cautious approach than in previous oil windfall episodes. So that's something that is also important to underline. Now, we also look at the more medium-term perspective, and it's important to get a good visibility on medium-term prospects, how this would fit into a fiscal framework, a medium-term fiscal framework that would take into account, in particular, future challenges that are more medium-term in nature, but which need to be tackled already now. And it's also important to have clarity on the fiscal stance, and that's also why we also always encourage the authorities to provide a comprehensive view, not only of the central government, but also of what is the policies that are followed outside of the central government, to have a better sense of what is the strategy over the medium term, for example, in terms of capital investment, what is a fiscal stance, and how we can better evaluate it.
You're jumping ahead and giving me perfect segues here into different questions. We have another question that has to do with sovereign wealth funds. Actually, two questions from the audience, one broad and one specific. So I'm going to go to Stephen's question that says, in the past, Saudi Arabia would spend more during oil booms and cut during busts. Now it says the budget is being insulated from those cycles. But the surplus is largely being shifted to the PIF, the Public Investment Fund, which seems to be following some old spending patterns. So the question is, has there really been significant improvement in fiscal stability, or has the risk just shifted from entities like the Ministry of Finance to the Public Investment Fund? So I guess the question is, how are you all thinking about the role of sovereign wealth funds, in this particular case, the Public Investment Fund, in these dynamics and the roles that it has to play?
Thank you. It's a very good question. And it's something that we indeed look at closely. First of all, we see that, and the recent developments, even if they tend to be positive, show also that to a large extent, the fiscal situation is not insulated from completely insulated from global developments, and more specifically in oil price developments. Now we try to stress the idea that basically some of the fiscal reforms that have been undertaken in previous years should continue. And they should continue in a way irrespective of the level, in particular, of hydrocarbon prices. Now, what we see indeed, and here we have variations between countries, is that on some public policies, that includes, investment and the realization of various development plans. Sovereign wealth fund in particular have a much bigger role, and again, there are variations between countries here in the region. At the same time, we see that central government keep playing an important role. That is the case in Saudi Arabia, where we see also a significant increase in capital expenditures in 2022. What we certainly encourage is, again, to try to have a comprehensive view of policies, that includes medium-term strategies which are well coordinated between the different actors, central government, sovereign wealth funds, SOEs, which are also an important component. And I have a more comprehensive view also just to look at assets and liabilities and what is the strategies, including in terms of diversification. So that's also why we, in our reports, have also focused on the idea of having at least some sense of sovereign balance sheets, which would include also sovereign wealth fund and SOEs. So we have looked at that, for example, in the 2021 report that we had on Saudi Arabia, and most recently in the Oman staff report that we published in November, and I would encourage you to look at that. So it's certainly an important consideration, an important challenge. Also because sovereign wealth funds have an important role to play in terms of diversification, but also, and again, this to a large extent goes together to have a greener economy, and we have seen some positive developments on that. But again, we also should keep in mind the need to develop the private sector to make sure that, in particular, there is no crowding out, and private sector and foreign direct investment also can develop and help develop those economies.
Yes, that continues to be a big concern when I speak with folks in the region, crowding out the private sector when it comes to competing with sovereign wealth funds or entities associated and partnering with sovereign wealth funds. So certainly an area that we need to watch closely. We're coming down to the last few minutes of our call, so I'll try to squeeze in one or two more questions. I did want to briefly touch on government debt, and you mentioned it briefly in your presentation. During some of the more dire economic moments of the past couple of years, there was a lot of concern about how Bahrain and Oman were managing their debt. Now that the picture seems to be better, we see the Omani authorities talking a lot more about managing their debt and diverting resources to this effect. How do you see the government debt picture shaping up at the moment, in particular with some of the sovereigns that had a more difficult time managing higher levels of debt?
The levels of debt have to be seen, of course, with the background of the positive economic development that we have seen, and also the efforts in terms of fiscal reform that we have seen in the past few years. Now, although Bahrain and Oman have the highest debts in the region, one has to look at relatively different situations and also different starting points. So, for example, in Oman, the starting point was a bit different. The situation has improved significantly on the fiscal side, with public debt around 44% of GDP in 2022, in line with significant fiscal reforms. So, and I would encourage all those who want to know more about this to read our recently published staff report on Oman, which was published in November. The case of Bahrain, there has been progress with fiscal reforms. The authorities are committed to achieving a budget balance. They have also, for example, doubled the VAT rate to 10%. The fiscal deficit has improved, even though it remained in double digits, and the external position has also strengthened markedly. And that's also something that is quite helpful, and that we see in both Oman and Bahrain. So this, even in the context of tighter financial conditions, and indeed we see some episodes of volatility, but the performance for a country like Bahrain has actually been slightly better than the benchmark for emerging markets. So that's also thanks to the renewed reform momentum and the favorable oil price outlook that we have seen.
Well, I think we will then leave things there on a good, bright note, despite being a somewhat rainy and bleak day here in Washington. We are coming up right upon the hour, so I'm not going to push things beyond our allotted time. My apologies for a couple of attendees who did not get their questions asked. I certainly had a lot of questions that I wanted to ask as well, but we'll save it for the next conversation. And as we mentioned, these reports and shorter versions of the reports are online, so you have a lot of information and content to dig into if you so wish. So with that, I would like to thank Jerome very much for joining us, and thank you also to your colleagues at the IMF who helped put together this wonderful report. And we look forward to hosting you again at AGSIW soon.